Gold's price tended to stabilize somewhat since the start of the week and is currently near the same levels it was as we released our last report. Yet in between there was wide volatility, with fundamentals playing a key role. Overall, we must note that the positioning of the USD, the course of US yields and the market's expectation for the Fed's intentions tended to drive the precious metals price in a rollercoaster ride in the past few days. In this report, we aim to shed light on the catalyst driving the precious metals price, assess its future outlook and conclude with a technical analysis. There are extensive discussion for the Fed's intentions lately and the possibility that the bank may start easing its rate hiking path from the December meeting onwards. The debate is hot and it was characteristic that Minneapolis Fed President Neil Kashkari stated that the bank may behave to raise its interest rate above 4.75% in order to curb inflationary pressures. On the other hand, St. Louis Fed President Bullard stated that the bank may have to end the front-loading of its hike, implying a shift in the coming year with more rate hikes still possible yet, at a correction mode and of a smaller size. It should be noted that economists seem to consider Fed policymakers as viewing inflation currently as a lesser problem than initially thought and are suggesting that the Feds may proceed with a lower, a 50 basis point rate hike in the December meeting. A view that seems to be shared also by the market partially, as Fed fund futures seems to provide a split probability of nearly 50-50 currently for a 50 or a 75 basis point rate hike, while bets that in the November meeting the bank will proceed with a 75 basis point rate hike. Market worries for inflationary pressures remain present among market participants and may still keep the USD at relatively high levels. Hence, we would also note the release of the core PCE price index, the Fed's favorite inflation metric, and should the growth rate accelerate further, we may see the USD getting additional support, as it would imply the extension of the Fed's hard, hawkish stance. Overall, we tend to agree with the market that the Fed may have to start slowing down its rate hiking path in order to reach a full stop in the midst of next year and have a look at the overall effect its monetary policy tightening may have had on the US economy and major metrics. Should the market's expectation for the Fed to ease its monetary policy tightening pace, we may see the USD experiencing some safe haven outflows, while gold's price, which is considered to have a negative correlation with the greenback, may benefit. Yet, also worries for a possible recession in the US economy are extended, with some analysts being certain for such a scenario to prevail, while we note that the US economy is already in a technical recession. The tightening of Fed's monetary policy, besides curbing inflationary pressures, is also expected to curtail the level of economic activity in the US economy. Thus, the possibility of recession is substantially possible, if not probable. Hence, we highlight the release advance GDP rate for Q3 on Thursday. The preliminary rate on a quarter-on-quarter is expected to get out of the negatives and accelerate to reach 2.4%, and should the rate surpass market expectation, we may see the USD strengthening, while at the same time gold's price may record losses, and vice versa. Should the actual rate fall short of the market's expectation, we may see gold's price gaining. At this point, we have to note that US yields stabilized in the past few days and today seem to be dropping somewhat, implying a peak and a subsequent correction lower. Should the US yields actually drop further, we may see gold's price rising, as the value of the precious metal could be of higher interest of investors. Thank you for watching.